Additional Superannuation Contribution ASC and Pension Related Deduction PRD. Let's start at the beginning and work our way through from PRD to ASC. The Pension Related Deduction, the PRD, was a temporary levy on public sector pay in Ireland from 2009 to 2019. It no longer applies today, but people still see the term when looking at old payslips, pension records or revenue documents. It is unfortunate that the HSC still retains the ASC/PRD as the description for this deduction, as it should only read ASC. Here's a clear breakdown, so you know exactly what it was and why it appears. What the Pension Related Deduction, the PRD, was. The Pension Related Deduction, often called the Public Services Pension Levy, was introduced on the 1st of March 2009 during the financial crisis, or as some like myself refer to as the banking crisis. I mention this as our national public holidays are still referred to as bank holidays in the popular media, given an elevated status to banks, as if they contributed in some way to funding public holiday entitlements, which of course they don't. The Pension Related Deduction, the PRD, applied only to public sector employees who had a public service pension entitlement. The key points: it was a compulsory deduction taken from gross pay. It applied to all public service workers with pension benefits. It was designed as a temporary emergency measure under the Financial Emergency Measures in the Public Interest, the FEMP Acts. The Financial Emergency Measures in the Public Interest, FEMP Acts, are a series of Irish laws passed between 2009 and 2015, including the 2009 Act, Number 2 Act 2009, 2010 Act, and the 2015 Act. They imposed mandatory reductions on public sector pay and pensions to combat the post-2008 economic crisis, or also known as, or aka, the banking crisis. Hopefully, this fact may be a catalyst for public servants to stop giving banks free media advertising and credit for our national public holidays by referring to them as bank holidays. That campaign to have public holidays referred to as public holidays, or Sarah Publi, is ongoing for us at Payroll Matters in Ireland and at Boyle Payroll Project Management, BPPM. While the Pension Related Deduction PRD reduced take-home pay, it did not increase any pension benefits. When PRD ended, PRD was phased out and fully removed by 2019, replaced by a new permanent contribution called the ASC, or Additional Superannuation Contribution. If you are seeing PRD on old payslips, this is normal, or historic pension statements, this is also normal. On current payslips, PRD should not appear anymore. Only ASC should. This is a summary table for PRD versus ASC, what replaced it. The Public Service Additional Superannuation Contribution, the ASC, is a deduction from the pay of pensionable public servants. It replaced the Pension Related Deduction, the PRD, with effect from the 1st of January 2019 and is administered by the Department of Public Expenditure and Reform. ASC payments are not chargeable to tax. They are chargeable to USC. ASC refunds are chargeable to tax they are not chargeable to USC. Here's a clear, plain English explanation of Additional Superannuation Contributions ASC and how it affects your pay. This is the system that replaced the old PRD pension levy in the Irish public sector. What ASC is? ASC is a mandatory pension-related deduction for public service workers in Ireland. It applies to anyone who is building up a public service pension single scheme or pre-2013 schemes. It replaced the PRD in 2019, but unlike the PRD, the ASC is permanent. What ASC actually pays for? ASC helps fund your public service pension and the cost of pension benefits you earn each year. It does not increase your pension benefits. It's a contribution towards the cost of the pension you're already earning. How ASC affects your net pay? ASC is taken directly from your gross salary, so it reduces your taxable income. It reduces your take-home pay. It works in bands, similar to income tax. The exact bands depend on your pension scheme, single scheme versus older schemes. But the structure looks like this, as seen on these tables. The higher your pensionable pay, the more ASC you pay. ASC is chargeable on pensionable remuneration only, and different rates apply depending on whether a public servant is a member of a standard accrual pension scheme, a fast accrual pension scheme, or the single public service pension scheme. Standard accrual. Standard accrual pension schemes are generally those in which members can accrue maximum pension benefits over a period of 40 years. Fast accrual, and also known as uniform accrual. Certain pension schemes allow members to accrue maximum pension benefits in a shorter time frame compared to those in a pension scheme with standard accrual terms, which are based on 40 years maximum service. For example, in certain schemes, maximum benefits may be attained after 30 years service rather than 40 years, as service after 20 years is doubled. That is, every year after 20 years you get 2 years service. Fast accrual terms apply to certain public servants who are required to retire early for operational reasons. For example, members of An Garda Síochána, prison officers, firefighters, and members of the permanent defence forces. Collectively, this group is sometimes referred to as the uniformed fast accrual group. The fast accrual scheme for psychiatric nurses allows for the early retirement of staff, with a preference for those with the longest service. The scheme is designed to facilitate the early release of staff, with priority given to employees with the longest service. The scheme does not apply to nurses registered under Section 65 of the 1945 Mental Treatment Act, as this provision allows for faster accrual rates of service for pension purposes. The scheme is applicable to new entrants to psychiatric services who joined the service after April 2004, as well as those psychiatric nurses who work in areas not covered by Section 65. The scheme is part of the Employment Control Framework and requires cooperation from staff in relation to redeployment, mobility, skills mix and flexibility. The single public service pension scheme The Single Public Service Pension Scheme, or Single Scheme, was introduced on the 1st of January 2013. It generally applies to individuals who join the public service for the first time on or after the 1st of January 2013, or who rejoin the public service after a break in public service employment of more than 26 weeks. The single scheme is based on a career average model pension accrual, with benefits based on a percentage of the member's pensionable earnings throughout an individual's membership of the scheme. ASC applies to serving public service employees who have a public service pension entitlement. It does not apply to public service pensioners. Transitional exemption thresholds and or rates applied from the 1st of January 2019, and a permanent set of exemption thresholds and rates has applied since the 1st of January 2020. Further detailed information on ASC is set out in Circular 21/2018, Transition to Additional Superannuation Contributions ASC from Pension Related Deduction PRD in the public service on the 1st of January 2019. Why your ASC might change year to year. Even if your job hasn't changed, ASC can go up or down because of 1. Annual pension increases, 2. Increment jumps, 3. Overtime or allowances, 4. Changes in ASC thresholds, 5. Moving from one pension scheme to another, rare but possible. ASC is calculated each pay period, so even small changes in earnings can shift you into a higher band. A simple example. Imagine your pensionable pay is €50,000. If your ASC bands were, for example, only 0% on the first 20,000, 4% on the next 20,000, and 7% on the rest, your ASC would be 0% on 20,000, €800 on 20,000, and €700 on 10,000. The total ASC, €1,500 per year. That $1,500 is taken from your pay before tax is calculated. The bottom line, ASC reduces your net pay. It does not increase your pension benefits. It is required for all public sector pension schemes. Replaced the old PRD levy. Varies with your income and pension scheme. It's essentially the modern version of the pension levy, but structured more fairly and permanently. Older schemes pay slightly more ASC because the pension benefits are more generous. Before I continue to demonstrate how ASC changes if your salary rises, let me say, as tax agents, as well as our main business of processing payroll for small businesses and completing income tax returns for PAYE workers, we at Boyle Payroll Project Management, BPPM, also administer the very popular Facebook group for PAYE workers to ask and get answers to a wide range of payroll, income tax, PAYE, and many more work-related questions. The name of the group is Payroll Matters in Ireland, and new members are always welcome. How ASC changes if your salary rises. ASC is banded, so increases in salary push more of your income into higher ASC rates. The summary. ASC rises slowly with increments. ASC rises sharply when you cross the €60,000 per annum. Older schemes always pay slightly more ASC but receive far better pensions. ASC forms. Public servants are required to fill out certain forms in respect of their additional superannuation contribution ASC liability at different times in the life cycle of their career, such as on commencing employment with a public service body, or when requesting a refund of ASC on cessation of employment. The various ASC forms are available here. ASC 10 form, Employment Declaration. An ASC form should be completed by an employee on commencement of employment in a public service body. If an organisation is unsure of an individual's pension entitlements across the public service, then they are entitled to request an individual to complete an ASC 10. ASC 12 form, Application for Refund. Employees seeking a refund of ASC should apply by completing an ASC 12 form and forwarding it to their local HR or payroll department. A refund of ASC deductions may be due when an individual ceases employment in situations such as retirement, resignation, end of contract, or commencement of a career break. ASC 45 form, Certificate of the ASC made in previous employments. Employers have a responsibility to issue an ASC 45 to an employee when they cease employment. It is a certificate of the ASC made in previous employments and employment to date in current year to date of cessation. The departing employee should retain the certificate and provide to any subsequent public service employer if taking up employment within the same calendar year. ASC 45S form, a certificate for former employees. An ASC 45 supplementary certificate should be issued in respect of pensionable remuneration paid to a former employee since date of leaving, which was not included on the original ASC 45 previously issued. The departing employee should retain the certificate and provide it to any subsequent public service employer if taking up employment within the same calendar year. An ASC 60 statement is an end-of-year statement provided by the employer to the employee of pensionable remuneration and ASC deducted in a relevant year in respect of that public service employment. Refunds of ASC. A refund other than a refund arising from an end-of-year balancing of ASC may arise in two scenarios. 1. No retained public service benefit. An individual ceases employment in a public service body with no public service pension benefit in respect of that period of employment. For example, they have worked less than 2 years in that employment and have not met the required vesting period to preserve or retain a pension benefit in respect of that employment. And A. In the case of those who have been members of the single pension scheme, they are not currently employed elsewhere in a pensionable public service capacity. Or B. In the case of those who have been members of a pre-2013 pension scheme pre-existing, they do not intend to take up another pensionable public service position and or they are not transferring the pensionable service to another public service body. In such circumstances, the individual is entitled to a full refund of ASC in respect of that period of employment. The relevant employer shall process a refund and issue an ASC 45 showing a nil ASC deduction. 2. Cessation of employment mid-year. Refunds in certain circumstances. The following applies where an individual retains a public service pension in respect of the employment from which they are ceasing. Such an individual may be entitled to a refund of ASC where that individual has not exceeded the annual exemption threshold and is not intending to return to work in a pensionable public service position in that year. Annual thresholds. Note, in accordance with the Act, an individual is entitled to the full set of thresholds in a relevant year. However, to ensure that the ASC liability is spread evenly across the year, the thresholds are set up on a pro rata basis, where a person ceases to be employed in a pensionable public service capacity mid-year and they do not intend to return to work in a pensionable public service position in that relevant year, they remain entitled to have their ASC liability assessed against the full annual threshold. Mid-year balancing. Where an individual ceases to be employed in a public service body during a relevant year, a mid-year balancing mechanism should be carried out to allow the individual concerned the benefit of the annual threshold, and a refund shall be issued by the employer subject to the following. A. Not moving on to another public service employment and not intending to take up public service employment in the current year. Where the individual is not employed in or moving to any other public service pensionable employment during the current year, then the relevant employer shall apply the annual set of thresholds, process a refund where applicable in respect of the current year only, and issue an ASC 45 showing the amount of public service pensionable remuneration and the ASC deducted in respect of such remuneration. B. Moving to another public service employment. Where an individual is moving to another public service employment, the relevant employer will provide an ASC 45 to the employee to furnish to the new public service employer, who will assess ASC liability based on pensionable remuneration in both employments and carry out an end-year balancing mechanism as we have outlined above. C. Concurrently working elsewhere in the public service. Where the individual is in another pensionable public service employment, be it a main employer or a subsidiary employer, the relevant ceasing employer will provide an ASC 45 to the employee to furnish to the main public service employer, who will assess ASC liability based on pensionable remuneration in both employments and carry out an end-of-year balancing mechanism as we have outlined above. D. Circumstances where refunds do not arise. Refunds from the former employer under B and C, as we have mentioned above, do not arise where the individual is continuing in pensionable public service employment, either in a subsidiary public service employment or in a new public service employment. E. In the case of B and C above, it may be necessary for the individual to nominate a new main employer where the ceasing employment has previously been the main employer. F. At all times, it is the payroll operator of the most recent main employer who will process any refunds. In applying for a refund, an employee is required to complete and ASC 12 accepting the terms and conditions of such a refund. ASC 12 forms will be available on the Per Pensions website. Recoupment of refunds of ASC. Where a refund of ASC has been issued under item 1 above, and the individual subsequently seeks, if eligible, to restore pension scheme benefits in respect of a prior period of pensionable employment for which an ASC was issued, the individual shall be liable to repay the refunded ASC subject to A. the application of the relevant thresholds in that year, and B. compound interest. Queries regarding refunds. ASC should be addressed to the main employer, who should liaise with any subsidiary employer in order to correctly assess ASC liability for the relevant year. Some time ago we did an explanatory video explaining all the items on a HSE payslip, and one of the issues addressed was the fact that the HSE continued to use the description ASC PRD after the Additional Superannuation Contribution ASC replaced the Pension Related Deduction, the PRD, and this causes a lot of confusion for HSE staff. Before I leave you for now, can I ask those of you that have not already done so to hit the like, follow or subscribe button depending on what platform you are watching this video guide on, as we have many more helpful pay, income tax and other work-related guides and videos to bring you. It costs you nothing to subscribe or follow, but could help you save hundreds or even thousands of euro into your hand on pay and tax. Go on, hit that like, follow or subscribe button. Go on, go on, go on, go on. See you next time, and thank you for watching.